Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. And in the spotlight today, we are putting down corporate earnings. Well, the Indian economy is starting to feel the heat from the ongoing slowdown that we are seeing in the global economy. We already know that the RBI has cut its estimate for the GDP growth in FY23, along with many of the other multilateral organizations. But what does that mean for corporate earnings? Will corporate earnings continue to enjoy the honeymoon period it has so far, or whether they will be the next in line to take the hit? Now, Santo, in my opinion, so far, if you look at it, from first quarter and second quarter onwards, probably the most volatile 6 months we have seen since COVID, came to these shores. Corporate earnings have shown a lot of resilience. I mean, in terms of downgrades, we barely saw like 4 to 5% sort of downgrade for the BSE 500 earnings back in Q1. So far, earnings season, if you look at it, earnings have largely been in line or have marginally beaten expectation, but we have not seen any sort of major deterioration in earnings. Like, say, for example, we are seeing in the West, where Facebook yesterday, of course, reported such a calamitous earnings performance. Apart from that, the festive demand that everybody was banking on has really come forth, in good colors. We have seen very, very strong growth. I mean, some automobile companies are indicating almost 40% year-on-year growth during the festive period. So clearly, the festive demand has delivered. Apart from that, usually you would expect that second half is when government capex also starts coming on stream. So that itself should also be a good positive as far as top lines are concerned. And in my conversations with market participants out there and some of the fund managers out there, Santo, my general sense was that they are expecting, very counterintuitively, actually earnings upgrades to start happening after Q2. Now, their argument seems to come from the fact that we have seen the worst of the hit on margins, and sequentially you would see margins improving because your crude oil prices have come down. Many of the major raw material prices which are shot up during the Russia-Ukraine war, they themselves have fallen quite substantially, and therefore it is very, very likely that you could see the nifty EPS, or the earnings per share as we know it, could touch 1,000 mark, the holy grail 1,000 mark by December 2024, which implies about 10 to 15% of good earnings growth for the next 2 years.
Well, CJ, this is something I've been constantly arguing with you about, which is that you've not been seeing this large scale earnings downgrades, but at the same time, very clearly most analysts have been trimming earnings estimates for the stocks in their coverage, and we've been seeing that across sectors. Now, interesting article Sonal Sachdev from CNBC TV 18 had written over the weekend, which he mentioned that if you look at the universe of BSE 500 companies, of the 128 companies that have announced their earnings so far, the top line growth has been fairly good. Aggregate top line growth has been about 22%. But if you look at the bottom line growth, that's been just about 8%, which means that the margin pressures are very much there. But of course, we know that Q2 was supposed to be peak of margin pressures across sectors, but we don't know that for sure. And at the same time, if you look at the top line growth, a lot of it could have also come through price rises and other things, which we don't know will sustain going forward in the current quarter as well. Again, the festive season has been pretty much mixed. I think some sectors would have definitely benefited from it, but others, like if you look at cement, steel and some of the other manufacturing sectors, it remains to be seen whether if they would have really benefited from this. At this stage, I would say, CJ, well, the numbers have been decent so far, at least not as disastrous as people had expected a couple of quarters back. But that said, let's not forget valuations are also fairly elevated at this point in time. So, stocks being expensive, the companies will have to come out with stronger earnings beat if they have to justify these kind of valuations. And Santo, that is where I think the problem lies.
It's very interesting because one of our viewers, Vinay Nayak, actually probably, his question is basically why Indian stock market not performing as bad as the global stock markets, and what the magic has been. And Mr. Nayak, I think this conversation is largely about that itself. The magic has been the fact that India's earnings growth has been much more resilient. We have not seen any sort of downgrades. So future earnings growth expectation largely on the fact that as far as India is concerned, you are not seeing any sort of deterioration in demand. Even though interest rates have gone up about 190 basis points so far, you're seeing a very resilient housing market, which was among the major triggers 1.5 years ago for the sort of earnings upgrade that we have seen. Now, FY21, everybody expected that earnings will not be that great. FY22, nobody expected or saw 30-40% sort of earnings growth that we ultimately delivered.
Correction here, CJ.
Yeah.
FY22 came off on a low base. So,
True.
right,
I do get your point, of
that.
course. But look at the COVID year itself, when everybody was expecting a disaster. Indian companies ended up, delivering almost more than 20% plus growth, if I'm not wrong. So I think even if you look at it from a nominal GDP point of view, Santo, with inflation somewhere in the range about 5 to 6% at this point of time, and even if your real GDP, which is growing according to the RBI, it will grow at about 7%. That itself means about 12 to 13% sort of a growth in earnings is almost a given. So in that sort of a scenario, inflation actually is not really that bad, because that ensures that your market will also continue to deliver at least 12 to 13% sort of returns on an annual basis, as long as nominal GDP remains around the same levels. And I think that is one of the reasons why Indian market is not performing as badly as we are seeing globally, because globally, clearly growth is now a problem. Growth itself, leave alone growth, actually recession itself is becoming an issue right now. You're already seeing the sort of earnings downgrade that we are seeing to S&P 500 companies. Yesterday, if you saw Meta's earnings, the stock in the aftermarket crashed almost 28% because of a slight miss on earnings. So that is the sort of fear that we are working with globally. But back home, at this point of time, things are looking much more rosier.
Again, you'll have to look at individual companies, CJ, because if you look at carefully at the numbers, in case of many companies, they are still just about getting to pre-COVID levels. But if look at the valuation, look at the stock price run up over the last 3-4 years, that's a huge difference.
That is true. And I think, Santo, we will have to be, of course, at the aggregate level, things are looking quite good. But ultimately, when it comes to investing, you have to also, be very, very stock specific. This is a stock picker's mind.
Irrespective of where the market goes, ultimately, which stocks you own in the portfolio.
Yeah, absolutely. You will always want to benchmark yourself against the market, and therefore market performance become important. But in a market like this, I think stock selection will be the key, and that is one of the reasons why you see a lot of fund managers these days, say or probably proclaim that active management is back like anything else. That is largely because they feel that outperformance will come from stock selection instead of just putting money in the index and hoping for the best. Well, that said, talking about the index, let's take a look at the trade setup for today. And it's looking like a very, very strong start for the benchmark indices. Of course, we have a catch up to do because we were not trading yesterday while the rest of the globe was. So in SGX Nifty at this point of time, it's indicating about a 70 to 100 point sort of a gap up move for the Nifty 50. Apart from that, the cues from Wall Street, although were a little underwhelming yesterday, because you saw the benchmark indices there fall, largely led by the decline we have seen in technology stocks. But seemingly the US dollar did fall a little bit. The US dollar index is now below the 110 level. A couple of weeks ago it was around 113, 114 odd levels. So now below 110 level, that is a very, very good news for emerging markets. And of course, oil prices have started to surge a little bit on the hope that probably with China coming back online, that could boost demand going ahead. So overall, Santo, the setup is looking a little positive for the bulls at this point of time.
Definitely, but I would also be watchful of whether it will be able to sustain. So let's not forget, CJ, a lot of short covering of positions has already happened in the last few days. And just a quick look at the statistics. Nifty put call ratio is at close to about 1%, which means that it's
almost at the
bulls and bears are evenly balanced. At 50% of the positions have been rolled over so far. In Bank Nifty, the put call ratio is over 1, which means that more put contracts have been written than call contracts, which is usually seen as a bullish sign. And 57% of the positions have been rolled over, so which means that probably the outperformance in the banking stocks probably could continue.
And I think, Santo, overall that could be a very good sign, given that banking is almost 25% of the index, so that should be a good sign.
Definitely, CJ. Well, and let's not forget, as I said, a lot of short positions have already been covered. So I don't think we can bet on too much upside from just from short covering of positions.
Yeah, the past 3-4 series we have seen that FIs have continued to roll over the short positions, and then they have been forced to cover it by the end of the series. This time it will be interesting whether they roll over those short positions or not, given the fact that for the past few series we have been able to outperform and indices have not seen that much of a price damage. So if those short positions are not rolled over, and do we see long positions going ahead, then we could see any sort of rally from the short covering that we have been seeing. It will be very interesting to see whether we see fresh buying coming into this market. I think that is the question on everybody's mind, because at this point of time we are largely benefited from the covering of short positions instead of new fresh incremental buying coming into the market.
And we are once again approaching a key resistance level, that is 18,200. So let's see if this time the market will be able to make a higher high after having failed on the previous two
hopefully a
attempts.
lot of people have been talking about record highs by December 2022. So let's see if that plays out or not. That said, the next section is of course newsmakers, and today on newsmakers my top pick is Gland Pharma. Well, the pick is largely because of bad reasons, because if you look at the earnings performance for the second quarter, it was not really something to write home about. The company's net profit slumped about 20%, along with sales declining about 3.3%, both on a year-on-year basis. If you look at the operating performance, that was even more disastrous, because the EBITDA slipped about 21% on a year-on-year basis. Plus, you saw a very hefty decline in margins as well. So, no surprises if the stock actually gets off on a weak footing today.
Well, and my newsmaker pick is Tata Steel. Now, there's been persistent chatter about the company wanting to sell its UK operations, and in an interview with CNBC TV18, Tata Steel MD and CEO TV Narendran has said that time is running out for the UK operations, and while it will continue to engage with the new government as well, it won't really wait indefinitely for the release of the funds, which is badly needed at this point. And just a backdrop here, the steel industry in UK is awaiting a £1.5 billion subsidy for mainly replacing carbon intensive furnaces with electric arc furnaces. So, Tata Steel stock could probably be in the limelight for the next couple of days, mainly on chatter.
Given the financial crisis and austerity drives that I've been talking about in the UK Santo, it seems unlikely that the steel industry will get any sort of money at this point of time. But we will track that story closely. Of course, there is that is a very important development as far as Tata Steel is concerned. That said, Santo, what is your hot brokerage bet for today?
Well, Varun Beverages by MK Global. MK has a buy rating on the stock with a price target of 1220, which it has upgraded slightly. Now, the play here, according to MK Global, is that mainly the company will benefit from its revenues in the Africa business, where so far it has shown some good growth, consistent growth in both Zimbabwe and Nepal, and the same kind of growth will now be seen in the Africa countries also. That's because PepsiCo is trying to increase its presence in Africa, which is a strong market for soft drinks. Right now, PepsiCo is present in just about 13 of the of African countries, and it plans to increase the number of countries. And this is, and also the company's strategy is to increase the number of franchised on bottling companies. So, which sounds good for, which is good news for a company like Varun Beverages. So, that's the reason why MK Global is bullish on the stock.
Well, Santo, my top pick is Aavas Financiers, now from the NBFC space, and this is one stock that I've also spoken about in the past. But if ICICI Securities came out with a report post the company's second quarter earnings, with a buy rating on the stock at a target price of about 2,845 rupees. Now, ICICI Securities clearly is very, very bullish. I mean, they're expecting in excess of 30% growth in disbursements or loan growth for the company over the next 2 to 3 years on an annualized basis. Apart from that, they're expecting very, very strong asset under management growth of in excess of 25% on an annual basis for the next 2 years as well. And overall, ICICI Securities is of the view that the company is now actually building up its sales force to expand its geographies, get out of its core market at this point of time, and that could be the next leg of growth. So this is one of those NBFCs within the the small housing space where it has been an outperformer since the time it has got listed. The earnings growth has been very, very strong, and the expectation is that this will continue. And therefore, I think if you look at the current market price of Aavas Financiers, is somewhere in the range of about 1900 to 2000 rupees. So clearly, almost a 30 to 40% of upside is what ICICI Securities is looking at for the next 12 months, Santo.
Well, and with that, let's move on to the main stock picks of the day, starting with Dabur. The company reported its second quarter earnings, and which were just about average. And the main concern for Dabur, according to analysts tracking the company, is the weakness in rural markets. And it's for the first time in 5 quarters that growth in the hinterland has actually lagged that of the urban markets. And the other area of concern for Dabur is that the weakness in its healthcare business, where competition seems to be intensifying. The healthcare revenues degrew by about 7% year on year, and remember, healthcare is about close to 36% of the company's revenue, so that is one area of concern.
Well, Santo, before I come back to my arguments against, for Dabur, let's quickly take a check at the market, and clearly we have had a very strong opening with the Nifty rising about 121 points at this point of time, and the Sensex jumping about 400 points, led by, it seems, the banking index, which with the Nifty Bank Index higher by about 0.7%.
And good breadth again. Close to about 1500 stocks are up, while less than 400 stocks are down at this point in time. So mid and small caps very clearly continue to be the flavor.
Yes, I mean, if you look at the Nifty mid cap index, the Nifty small cap index higher by about 0.3%, 0.4%, 0.5% respectively. Sectorally, I think, Santo, almost all of the sectors at this point of time on the NSE are in the green territory, very surprisingly. Even the Nifty IT index, which has been berated so much, is higher by about 0.2%, but it's the metal space, surprisingly, which is doing really well. The Nifty metal index higher by about 1%, and that seems to be coming from the optimism that with China probably coming back, and a lot of stimulus there coming on board for next year, 2023. I think the metal space is expected to do quite well. I think that is the hope that the market has. But apart from that, if you look at some of the other spaces, Nifty Realty higher by about 0.7%, Nifty Auto Index higher by about 0.6%. Coming back to Dabur India, of course, I think the second quarter numbers, Santo, I think largely were in line with what market was expecting. Yes, some of the fear were already built in given the Q2 update that the company had given prior to the earnings release. But I think the catch here actually should be, or the news for me actually, is the acquisition of the 51% stake that the company has made in Badshah Masala for about about 600 crore rupees if you look at it. And I think this is going to be a very game-changing acquisition as far as Dabur India is concerned, largely because this will boost the revenue profile of the kitchen condiment business. I think that is what Goldman Sachs has also had to say. They believe that the buyout will bring the kitchen condiment business into a new stratosphere altogether, and overall that should be positive for earnings, and it should be accretive to the earnings per share of the company, and we could start seeing the impact of this in the coming quarters as and when the acquisition is completed.
Well, analysts tracking the stock, CJ, also say that in the first year it's going to be EPS neutral.
But the second year onwards, you can start expecting maybe FY24, FY25 onwards is when you'll start seeing the actual benefit. And so therefore, I think it's a very, very shrewd acquisition that the company has made, given that at this point of time, it seems like others like HUL was also reportedly looking into acquiring somebody in the kitchen condiment segment, and this seems like a market which has suddenly become very attractive. It seems like everybody wants to be a cook nowadays after the pandemic, so maybe that is the reason why I think Dabur India has looked at this acquisition. Well, my first and last pick, of course, on this section is Century Textiles, and what a stellar show, Santo. If you look at the performance, I don't think anybody saw this sort of earnings performance coming in from Century Textiles. The company's net profit jumped almost 60% on a year-on-year basis, along with sales rising about 21%. The operating performance itself was very, very strong, and a lot to write home there. Operating profit rising about 64% on a year-on-year basis, plus margins expanding 330 basis points, Santo, on a year-on-year basis in a quarter like this, when everybody else has been talking about either just retaining their margin level or probably a little bit of deterioration. Century Textiles has come in with a 330 basis point expansion in margin. So I think that is something that will truly hearten investors of the company.
Well, CJ, no disputing the latest quarterly numbers from Century Textile. Clearly, there has been a marked improvement in its earnings over the last couple of quarters. My only quibble here is again that Century has been unable to show consistency in its earnings for many quarters now. Some years the numbers are very good, and then suddenly and that's reflected in the stock price performance also. Although the stock is now three-bagger from the pandemic lows. If you look at over the last 5 years, it's still not delivered good enough returns for somebody who's holding it for a long time. So I would wait for some more consistency in earnings to come through, CJ, before I would take a slightly more rosy
Yeah,
view.
I think Santo, this is one company which is riding the cycle, not only in the in the furniture business, but also if you look at the real estate division as well, that is also said to be doing quite well, and the company is looking to get into new projects at this point of time, and I think that is why we are seeing the sort of improvement that we are seeing in the earnings for the past few quarters, and hopefully long may it continue going ahead.
Well, South Indian Bank is the next stock on our watch list. Now, this has been a major underperformer for quite some years now, but finally things seem to be looking up after change in management. The company has changed its strategy. There's been a lot of stress in its corporate book, and so it's been following a quality over quantity approach according to brokerage house ICICI Securities, which means that it's now changed the profile of its borrowers and now is focusing more on the top rated borrowers. In the second quarter, there's been a significant improvement in the asset quality also, and besides an expansion in its net interest margins, which ICICI Securities feels will continue to be the case for the rest of FY23 as well. Anand Rathi is the other brokerage which is bullish on the stock and has a price target of 15 rupees, whereas ICICI Securities has a price target of 13 rupees for the stock.
Well, Santo, clearly the new MD, ever since he has come in back in 2020, I think he has brought a lot of stability as far as the operating performance of South Indian Bank is concerned. But for me, the only thing to watch out for would be how credit costs, evolve from here on. So far, the lender has been able to keep it around the 1% range, of course, because of NPS falling. But as loan growth surges, you of course, within also they are trying to, pivot to a retail banking sort of a setup from a corporate loan sort of a setup, and therefore as loan growth surges, sometimes you see credit quality start deteriorating because you are chasing growth at a very, very fast pace, and therefore I think that would be one key trigger that I would want to watch out for as far as sustainability of this performance is concerned in the coming quarters.
Well, last stock on a watch list this morning is Sharda Cropchem. A middling set of second quarter numbers, and in fact it is the third successive quarter where the top line has been declining now. Margins have been under pressure. There's been a slight improvement if you look at it on a sequential basis. It's gone up from about 6% to 9%, but still it's nowhere near the 15 plus percentage margin which the company had been enjoying for some time now. And as a result, the company has also lowered its margin guidance for the rest of FY23 to about 15 to 18%, which at this point seems like a tough ask, given that the margin for the first quarter was 6% and now it's just about 9%. And European volumes were down about 4.5% during the quarter, and that is again another major pain point for Sharda Cropchem.
Clearly, Santo, I think the weakness that we have seen in the second quarter was largely due to the forex losses, the hefty forex losses that the company has taken because of the depreciation in the euro against the US dollar. Now, Sharda Cropchem has a large chunk of its business emanating from the European continent, so clearly that was always going to be a major negative. But thankfully, the management have indicated that they have started to take mitigating steps, including forex hedges, trying to increase growth in other markets such as the NAFTA region, which is basically a North American region. And I think that will be the strategy going ahead. They are looking to improve sales in North American market much more and more, and trying to reduce the dependency in Europe, especially given the economic crisis in that region at this point of time. Apart from that, if you look at it from a valuation point of view, I think overall, growth trajectory looks still quite decent. They maintain a top line growth ambition of about 15 to 18% at this point of time. They have trimmed it down, but it's still a very decent, top line growth assumption at this point of time if you look at the way the market is. And therefore, for me, the risk reward probably is becoming more and more reasonable given the stock correction that we have already seen on this counter, Santo. Well, Santo, before wrapping up, let's take a few questions from our viewers, and we have got a lot of questions. So thank you guys. Thank you for utilizing the hashtag AskMC, and you can keep on posting your comments and questions there. Santo, Bishek Manik wants our thoughts on Indus Towers. Now, this is an interesting stock within the telecom space. It seems like Indus Towers had started to revive its fortunes, but especially when the 5G auction happened. But then, given the sort of diverse plans that all of the two or three major corporate companies there have, it seems the market has lost a little bit of that confidence or exuberance for Indus Towers.
Well, yeah, and the stock had bottomed out around 190 levels, and it had seen some bit of buying interest there. It's reasonably valued, but at the same time, market again in this case is not very, doesn't seem to be very positive on the outlook. Besides, Indus Towers also I think Vodafone owes
ongoing troubles with Vodafone. Of course,
it's owed money by some of its clients at this point in time, and there is some concerns about that, which is why probably you're not seeing a huge re-rating of the stock, although it seems to be fairly valued at current level.
And also Bharti Airtel, Santo, they have indicated that they really are not going to go gung-ho on the 5G capex. They really want to utilize their existing 4G network and bring 5G on top of it, unlike say its rival RIL, which wants to have a standalone 5G network. And I think that also clouds the sort of tenancy growth that you talk about for Indus Towers. I think that clouds makes it a little bit more hazier compared to what the expectation that the market was working with. But otherwise, of course, if you look at it from a long-term perspective, this is a growing sector at this point of time. Given the dependency that we have now on data, I think this is something to watch out for. Apart from that, Santo, another viewer, Baswaraj Bhimareddy, he wanted our thoughts on Bandhan Bank. I think for me, Bandhan Bank, I mean, it seems to be a repetitive broken clock sort of a story. I mean, every quarter you have some sort of improvement coming in its major geography, which is Assam, but then some sort of natural calamity happens there. I mean, last time around with the monsoon season, it was around the floods that the region had faced, and because of that, again, the outlook on the lender had started to deteriorate after almost 2 quarters of improvement. And therefore, I think as long as Bandhan Bank's microfinance business in particular remains dependent in the northeast region or too concentrated in that region, I think it will continue to face the sort of volatility that it has been facing going ahead. Well, I think, Santo, that would be probably the last question that we have time to take. So therefore, I think good time to
yes,
wrap up
and
today.
with that, it's a wrap. Thank you for watching, and continue to post your feedback as well as questions to us. We'll try to answer it to the best of our knowledge.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, you can stay tuned to moneycontrol.com or download our app from the Apple Store or the Google Play Store. We will catch you live again at 3 p.m. Till then, have a great trading day.